Hey guys, good morning. It is Saturday, 9:11 a.m., 5/23, 2020. Welcome back to the show. I wanted to cover a broad scope of topics this weekend, hopefully help out some traders and people looking at the market, scratching their head, wondering what the heck's going on. Just to give you a little bit of background, I literally started trading probably 25 years ago on my phone at work. I was a truck driver, believe it or not, for a sanitation company and was driving a roll-off truck, which is the big dumpsters, and I would pull over between stops and trade. So I literally learned from the ground up in the trenches. And over the years, I've really learned a lot about what drives the stock market. And I've come to the conclusion that the stock market is driven by 100% human psychology. The psychology of fear and greed. And I understand a lot of people are going to say, well, that's not true because there's, fundamental ingredients like earnings and fundamental economic data, which is true, but it's really more of a perception of that information. It has nothing to do with the intrinsic information itself, per se. So, for instance, we look at something like Tesla. Tesla dropped, 10 points yesterday? And Tesla has, 180 million shares in their float, which means that you would say Tesla, for whatever reason, just based on news, lost $1.8 billion in market cap value. Did it really lose that intrinsically? Was there a report on earnings that said they lost that amount of money? No, it was the perception of what the information was in the news, and they extrapolate that into share price movement. So when you look at all the companies on the S&P 500, and not so much the S&P 500, but the overall general market, there's a huge percentage of companies that are zombie companies. They don't even make any money. Okay, they're just traders trading those movements of stock price. That's it. Human psychology. If it's moving, they want to buy it. How many times do you see traders just trading a stock in the morning, and it's got to be, the numbers are probably 95%, where a day trader is looking at these penny stocks gapping or whatever they might be, low float, $2, $3, $4 stocks, and they're buying it just based on movement. They have no idea what the company does. And if they do know what the company does, they don't know anything about the company's intrinsic value based on earnings and their debt and cash flow and stuff like that, bottom line, top line. They don't care. They just care about movement. So for those people that are bearish on the market saying, well, the earnings are going to come out in next quarter and they're going to be really bad. So I agree with that, number one. And I do think that could cause a pullback in the market. And we'll analyze that pullback and based on our technicals to see how far and how deep that goes if that is to occur. But once again, we go back to the psychological portion of the stock market where it's not going to matter because you're not the only one that knows that information right now. That information's out there. Everybody's thinking about the same thing. Wow, the earnings are not going to be good. Yet the market's at where it's at. So, down the road, we could look back and say, wow, that was a bubble. And it happens. We saw it in the housing market. The market just continues to go higher. Prices of houses were doubling in a period of, 2-3 years. Up 30% over a period of a year, or whatever the numbers were. But you kind of knew it was a bubble. You just didn't know when it was going to end, and you probably participated in it if you're a realtor. And if you didn't know it was a bubble, then shame on you because you would have got caught by surprise. So I don't get caught by surprise in the market because I know the economic backdrop. I know what the Fed has produced here, and I don't fight it. Don't fight the Fed. So that's number one. Number two is we look at all the people that are negative on the market. And I can go into the YouTube videos of all the guys that have been wrong. It's every day. It's the same freaking thing. Market crash update. Did the market just do a head and shoulders break? Did the market break the neckline? Did the Dow Jones just triple top? And we've talked about this over and over again. And they're wrong all the way. They're wrong here. They're wrong here. They're wrong here. Everybody has been wrong the whole time. First of all, I don't know what they're looking at because if we look at the S&P 500, I have some proprietary stuff that I do that my lines and the market's lines were in the blue. Your average investor was saying, well, this was the bottom and this is the tail and we just broke the neckline. But that's what I call momentum line. This is more of a sideways consolidation line because of the multiple touches on the tail. Here, close above it, here, close on it, here, tail here, close on it here, tail way below it, bad data, tail on it here, and then we push higher. We back test the momentum line, and then we fire higher. So anybody that thought we broke a head and shoulders pattern, I did a video on that, and the video was questioning that, did we really break a head and shoulders pattern? I said the market was moving up from a different trajectory, big move, right? And did more of a sideways pattern. Now we've crossed the 200 exponential, and we're kind of grinding there. And I like to see at least 4 days above either a line that I have drawn for directional changes based on market psychology or a moving average. So we've got 3 in the book, right? One will close above it, then we pulled back. I think that was on Tuesday. And then Wednesday, Thursday, and Friday, all above that line. And this is bullish action. In fact, the back test 2 times on the momentum line was bullish action. And guys are saying, oh, we hit it and we can't get through it. Just to even hit it and go back up and close on it twice is very bullish action. So I've been doing this a while. It's the same thing. There's either 2 things that can happen here. And let's talk about some other ingredients too. If you're bearish on the market, you're either doing one of 2 things. If you're not in the market, you're either short the market or you're completely uninvolved in the market. And then one of 2 things can happen. If the market starts to go higher, you're either going to cover your short or you're going to join in because you can't stop. You can't handle watching it anymore. You got to get in. FOMO. So a couple ingredients to consider too. If stocks are moving not based on economic data, not based on intrinsic value, they're completely ignoring the fundamental backdrop. We see it all the time in trading stocks, right? Do you not think that same thing can't happen with the macro market? It's called a bubble. We see penny stocks that run up, gap and crap, the pump and dump, whatever you want to call it. They fly to the upside. There is no fundamental reason for them to do that. It's more of traders. In a larger sense, yes, it sounds crazy, but the overall macro markets can do the same thing. They can continue to go higher based on human psychology, especially with all the retail investors that we've seen pile into this market in unprecedented levels. The numbers are extreme. And if I could learn how to do screen sharing on OBS for my web browser, I would probably show you some of that empirical data. But the bottom line is stay safe. Don't keep shorting the market. Don't chase directional moves. Once we break certain levels, then we can start to scale in shorts looking for a bigger move to the downside. So let's go into part 2 here. Part 2 usually is more of a technical thing that I'm looking at and more built into market psychology. I use the Heiken Ashi candles for my trading data just to kind of get an idea of where we're at in the market. That is not a Heiken Ashi candle. And it kind of just keeps me safe and kind of figuring out what wave we're in. And let's stretch this out a little bit. So we know what the Heiken Ashi candle does. It collects data based on the prior high, low, close, and volume of the previous candle. And it helps us look not so much intraday trading, and I do use it once in a while, but it's a little bit of a delayed reaction, so it's important that we don't use it so much for day trading because we can get caught a little bit behind the 8 ball and a little behind the price movement there because it's happening in real time, and this is a little bit of a slower process. So when we look at the S&P 500, very similar to the QQQ where we're on leg 5. We have leg 1 here, wave 2, we could just say wave 3, wave 4. And wave 5 is usually what you have before you have some type of correction. You could go into a blow off to the upside like we talked about and possibly where everybody's saying, wow, I got to get in. This is the real deal. And that wouldn't last. That would be a very weak leg movement to the upside and one that probably should be shorted. But now you can see that we're probably, usually have a 2 or 3 day consolidation on a Heiken Ashi. And this type of a candle that we see here with a very, very short body and a long wick and tail precedes some indecision. So obviously coming into a holiday weekend, you could have some indecision. And then next week, I believe you'll have a pullback probably starting on Wednesday or so. Is it going to be like everybody's saying? That's another thing I want to cover too. And let's get into that right now. The market doesn't have to just either go up or crash. I mean, once again, you go on and you get trader perspective, you get the professionals, they're saying this market is the most dangerous market, it's overvalued, and they start drawing these Elliott wave theories, we've just completed this and we're going to crash. Or they say we're going to blow off to new all-time highs. How about the market just goes sideways? I mean, that old saying that the truth usually lies somewhere in between is pretty applicable for the market as well. The market doesn't have to go flying to the upside or crashing to the downside. Most likely, if we pull back, maybe we can go retest this momentum line or even this channel in here. So if we want to remove some of this stuff, we can kind of get an idea of what we're looking at. And I would expect, unless something significantly changed fundamentally, that if the market does pull back, it's going to be healthy for the market. And basically, I'm somebody who thinks the market's overvalued to begin with. I acknowledge that, but as a trader, I have to recognize that, just like in the dot-com bubble, that I can't fight that action, and might as well just join it because I am a trader. So maybe something, along these lines here is what we're going to see in a pullback. And it's hard to even draw an upper channel because, it's probably going to be somewhat accurate along these lines. I haven't really drawn that yet. I look at a lot of different things when I'm making these lines for trading, but just a simple channel may look something like this. So what's going to happen is if we do pull back here, people are going to panic out saying, oh my God, it's on. The big drop is in. But meanwhile, we're just grinding, burning time off the clock here, chopping in some sideways to slightly upward biased channel action. They're going to freak out though, and that's what's going to happen. But we're not going to do that. We'll be ready because we understand how the market psychology works. Unless something changes fundamentally, the psychology will be in place, and the psychology is climbing the wall of worry with the market going higher. If you look at action like in TBT and TLT, it's the same thing. There's a little bit of hedging going on here. A little bit of hedging ahead of any type of market movement, but you would see bigger moves in TLT prior to a big market dump like that for sure. You can see it in TVIX as well. Is this action that we're seeing in TVIX indicative of something that could precede a big move to the downside? Well, it's actually held an interesting lower area here. In fact, that's the opening candle. But if you look across here, and let's kind of zoom in big time and then move this over. A lot of times people see movement in TVIX or the volatility index, and they chase the movement. To do so here made you a boatload of money, a boatload. And to do it down here though is a little tricky because they see it fire up intraday and they're like, it's on, here comes the drop, and they chase it and then they get burned. Stop doing that. Stop doing that. The way to play the TVIX is actually during times of extreme complacency. You want to scale in small portions, but you do need to sell into strength. Like here we had some complacency and you got a nice move there. This looks like a little bit of complacency, but the strength that we're seeing on this floor in the TVIX and the volatility index could actually be a little bit of hedging going into a holiday weekend. It could be a little concern that where the market is currently at, there's not a lot of positive risk reward ratio in the short term, so a lot of guys are positioning for a big drop, and that's actually what's holding it up. Now if that doesn't unfold, then you're going to see the volatility index actually start to slowly go lower again, and you're probably looking around 100 on the TVIX. I know you're thinking that's hard to believe, but it's very possible. So nice little floor in here to kind of play off of, and we talked to that around the 148.50, as long as you don't close below 148.50. In fact, sometimes you can close low because usually lower lows, this is a weird a weird market psychology, ETP, I guess it is. Usually directional changes are usually preceded by extreme movements in one direction or the other when it comes to TVIX. So this extreme move caused a more extreme move in the other direction. This big move up here caused a big move that way. So there are two ways to play that. Either in times of complacency, you scale in, but you have to really respect the stop on a slow grind lower, or you get a big move to the downside. That's when you want to actually buy into it. That's utter complacency over bubbly move to the upside in the market, and then you cause a fire back the other way. So normally in a stock, you don't want to buy it when it's breaking down, right? This looks ugly from here to here in a stock. You'd say, wow, I got to get out of that. In the TVIX, that's actually when you want to get in that. And then this in the stock, you're like, I got to get in that. Well, this is when you want to get out of TVIX. Once again, move to the downside. Oh boy, this is horrible looking on the stock. I broke this, bear wedge here and this bear pennant. I need to get out. That's actually when you want to start thinking about buying TVIX. Once again, in the same thing right here, most stocks you'd say, I want to get out. I just broke this little channel line. In fact, that's when you wanted to get in, usually 3 or 4 day move to the downside. So it could be the same thing here. And these aren't perfect I'm just showing you little wedges here. But this could be the same thing. If we have a big movement, like I said, a blow off to the upside, and you have those 3 or 4 day moves to the downside, that's when we want to buy TVIX. Okay, that's when we want to buy TVIX. So I'm going to finish up with our EVFM that we bought and we recommended. And luckily our subscribers crushed it on this one. I don't think we got the full extent of the move, but we'll see. I sold some in after hours. It was weird because looking back, one of the subscribers told me that the news actually came out during the day. To me, it looked like a forced sell by some big money guy that wanted to crush the stops and pick up some cheap shares because they immediately ran it from $4 down to back up to like $5, and maybe they knew something. But they did say that the FDA had already posted on the website that that their Phexi was approved, which is a non-hormonal contraceptive gel, which could really take off in sales here. But they will have to fund that sale process on a secondary. So we're playing a little tricky. This actually made my day. Friday, I had a great day. We hit our goal, and we were not going to hit our goal because of Thinkorswim being down in the morning. I was behind big time, and this just crushed it, man. I made a lot of money on this. So nice move. I did sell 1/3 of my position. I was kind of tooling around, buyback, sell, buyback. But I'm still holding some position, looking for a move up. And I think what we're trying to do here is scale out into strength and then wait for the secondary to be announced and then try to scale in the secondary. If they drop it down to, $6 a share on the secondary or whatever, depending on where we're starting at. If we're at 10, they might drop it to 7. Who knows? And then who knows what the offering is going to be, what price and what amount of shares to fund this sales process. But if they do that, we want to scale in. We could hit 7, then drift down to 6, then 5.5. I'm just using numbers, just throwing out examples there. Well, those same positions that I held up here that I sold, I probably want to scale in at a lower price. Now I'm playing with the house's money for sure, looking for some success on the other end of this fundamentally on the sales process. So we'll see how that goes on EVFM. Most of the stuff that I recommend is safe. You're not going to come on my channel and see really fun stocks that are crazy, penny stocks flying. So the stuff that I recommend, you might say is boring, but these are 20-30% movers that I don't want my subscribers to get crushed one day with their stock opening up, cut in half. In fact, we don't even recommend buying and holding stocks like Shop, but we do say this is a great stock to buy on pullbacks intraday. And we'll go through some more details on some trading strategies and stuff that I look at intraday and mistakes I've made in the past that I still continue to make, getting back into the market again after being out a year, that I need to tighten up on to get my true potential here in this market. Given the backdrop here, there's a lot of money to be made in this crazy casino market. But we're not going to fight it. We're gonna join the crowd and keep ourselves safe by looking at different pivot points where we break. And not just trying to short the market and hope. That's not the strategy we want to use.